Hey, business owners. So today we are going to talk about trade credit. And I actually have with me Matt here today. I love the information you shared about trade credit. So I thought it would be important to share it to everyone else as it's such a valuable tool. I'll let you introduce yourself and then we'll dig into what trade credit is.
Sounds good. Yeah. Matthew Kowalak from Allianz Trade. I've been with the company for a couple of years now. We're kind of what's called a monoline supplier. So we are the actual insurer and then a direct sales force for it. We only do trade credit insurance. So we work with a lot of insurance brokers and bankers because this is typically an overlooked product. There is an E&O aspect to this, an errors and omissions aspect. So that's something I like to bring up with brokers, right? Should one of your clients potentially take a loss and they haven't been introduced to this, there is potentially some liability there. So we're just trying to, cross all the T's and dot all the I's and help make sure that nobody gets, like I like to say, gets their fingers caught on the windowsill when the window's coming down. So, so
the more you shared with me about what trade credit was, I definitely saw how this can help companies grow and scale, have more confidence in that, right? And not kind of cap themselves to their own risk tolerances, right?
Right.
And so I guess let's start off with a real simple explanation, what is trade credit?
Trade credit insurance is a poorly understood tool. It is labeled insurance, but it's really more financial consulting, right? We have the largest database of financial information on privately held companies in the world. And basically we sell access to our analysis on who's credit worthy and to what level. And then we back up our assessments with a guarantee. But we insure accounts receivable, right? So we're working with a policyholder or prospect. We look at who their buyers are and we assess their credit worthiness on a number of 1 through 10, right? 1 is Amazon, Walmart, 10 is declared bankruptcy. 9 is, the lid's on the coffin, but the nails haven't been hammered in yet. But so, and we assess their credit worthiness and then give them a number, what's called an ADT, an automatic decision threshold. So up to a certain amount of credit will cover without any further financial information, right? So if a customer comes to us, and I just had this happen the other week, they're offering $75,000 in credit to a credit limit to a buyer. Buyer wants 200,000. You think about what that credit process looks like. You're maybe talking to the bank, maybe getting some trade references, but really it's at best educated guessing. And we come in there and say, hey, this is a specific number that will guarantee payment on, right? So if your sales team is saying, hey, I could sell these guys 150,000 per transaction all day, and you're capped at 75 because you just don't feel confident in the information that you have, we kind of shed light on that. And we're monitoring not only your customers, but all of their customers as well. And so what we do is basically like if you've ever used Google Maps while you're driving, you see a notification pops up and it says, hey, there's a stalled vehicle on the left. It was reported. Is it still there? And so that's what we're doing, crowdsourcing that data on companies' creditworthiness. Maybe they're still paying you, but they stopped paying a transportation company of theirs, and they stopped paying a packaging company. And what we try to assess is, are there enough of these red flags to either reduce that credit level or have they improved and you should increase it? Thinking about credit, people like to say America runs on Dunkin', America runs on credit. And once the dominoes start falling, you can see that. And that's kind of the situation we're in right now, where the volatility and the uncertainty of the economy is susceptible to these issues, right? And when one company goes bankrupt, especially in a supply chain, that can have a domino effect and you can get caught into it. If you're lucky, it's just a small wound, but for some of these companies, it can be disastrous. And that's why sometimes we kind of refer it internally as nightmare insurance, right? It's good sleep at night insurance to make sure should anything terrible happen, you're covered. But there are several other benefits, and we can discuss those as well.
When you were first sharing this with me, the way that I interpret it was if I'm a manufacturer and I have a relationship with one of my vendors and they want to purchase $500,000 of materials or whatever it is that I'm manufacturing, it's based on my relationship with them, kind of like my personal relationship. Do I trust them? How much do I trust them? Have we been doing business for 5 years, 10 years? Have they ever, had a slow month paying me.
Right.
And
Some
what
kind of
this
hiccup.
tool, yeah, and what this tool does is it really gives you that confidence to say, oh, I could actually do 200,000 more in credit for whatever it is that they're looking to purchase from me. And that just opens the doors to more growth, more opportunity. And that's like a trusted relationship. But then you have another relationship that you don't know who this person is, so you start small. You start
Right.
small and take 5 more years to build that relationship to be able to increase that capacity.
Mhm.
When if I were to partner with you, right, as a manufacturer, I could have that 5 year data today in less than, I think you said, what, 24 hours or something.
Right.
And I can make a much faster strategic business decision for my business, essentially.
Yeah, so those are some of the questions we typically ask when we're trying to suss out, is this a good fit? Because,
Mm-hmm.
I think a lot of people have this concept of insurance. Hey, I buy this policy, I put it
Mm-hmm.
on the shelf, and I hope I never have to use it, but it's there in case
Yes.
I do. And so the difference with us is this really should be a financial insight. It's more of a consultancy, right? You're hiring us to to set those initial limits at exactly where they should be. And we really talk about maximizing your revenue from within your existing client list, right?
Mm-hmm.
To go back to that story you mentioned, I've got a project today where I'm, a company, a steel company. They've got a client list. They sent us over 20 of their buyers. They've been working with these companies from between 5 and 15 years.
Mm-hmm.
And after looking at their list, we're turning around in 48 hours and saying, hey, you could sell this company triple, 4 times, 5 times, up to 10 times as much as you're currently selling them. The sales team is saying, hey, look, we feel like a dog on a leash here. We're chomping at the bit to get out there, and they can say they can buy more, but we just
Mm-hmm.
don't feel confident with the financial insights. And then you think about the amount of time and money that goes into building a credit team and then monitoring. And then at the end of the day, they're still really just saying, okay, well, DNB says this and their bank said this. Let's just put it here and we'll see how it goes. What we can do is come in there and show you exactly what level. And again, the team likes to say is, hey, it's guidance, not gospel, right? And so if you've got a buyer that says I can take 400,000, and we say, hey, we'll insure 300,000, you can sell them for 500,000 if you want. We're gonna say, hey, we're only comfortable insuring XYZ amount. So you can. The way I like to use the alliteration is it's like going bowling and using the bumper lanes, right? We're
Mm-hmm.
not guaranteeing a strike anymore, but we're promising you're not going to roll a gutter ball. And so that's kind of the way to think about it is you have that guidance in there to say, hey, this is where you're safe. Beyond this, you're taking on some additional risk. And then as I just mentioned, right, how often is a credit team going back and reassessing credit, right? Are they requesting more financial information every quarter? Maybe every year, but in my experience, it's pretty rare that a credit team is going back and reviewing an existing client's credit worthiness. And so I
Yeah.
think for us, that's really where we're trying to add that value is saying, hey, we'll take over that. We'll monitor everything. We'll tell your credit desk exactly, what to set these levels at. And my goal again is to turn that credit manager into more of a project manager. So instead of sales breathing down the credit desk's neck saying, hey, I need a reply on this, it's the other way where the credit manager is saying, hey, I need more applications. Go find me some new projects because we can
Yeah.
just set these levels as is, and then we'll go back and reassess. And so I think that's really the strength, in terms of what we're doing, right? So we're one, preventing that bad debt, nightmare insurance should something happen.
Mm-hmm.
Number two, maximizing current customers and new opportunities and getting exactly where those credit levels should be, streamlining and strengthening the credit department. And then the final one, the most complicated one, is building a deeper relationship with lenders, and we can dive into that as well, and
Yeah.
kind of increasing that borrowing base, right? So that's the fourth and final pillar of trade credit.
Yeah. Yeah. So let's talk about that actually. Where you said that, you can leverage your accounts receivables to build more confidence with the bank, when you're going
Right.
in asking for credit lines, loans, whatever. Talk to me a little bit more about that and how that works with trade credit.
Yeah. Why don't I've got a slide here. I just did a presentation. And maybe that will. Let's
Great.
see if I can do this real quick.
Mhm.
That maximized. whatever, close enough. Okay, so typically we would look and see a situation like this, right, where a company is doing what we call pledging their accounts receivable, right? So they're
Okay.
going to the bank and saying, hey, I have $1 million in sales. It's due on net 60, and I need some cash flow earlier than that. So I take this $1 million, I go to the bank will give me an advance rate. So in this situation, we have a company, it's got 40 million in total sales, 30 million domestic, 10 million export. Again, as I mentioned, this used to be a much more interesting conversation in terms of exporting. Fingers crossed that'll turn around again. So
That's
then
right.
their average accounts receivable, so how much they have extended credit, right, over the year. So they're extending their credit in 2.5 million chunks domestically, $833,000 chunks export wise. So before they go to their bank and they say, hey, look, I've got these, whatever this is, 2 million, 3 million, 3.5 million in sales in total AR, whatever 250 plus 833 is.
Yeah.
How much will you advance me, right? So how much can I borrow in terms of short-term cash flow against those accounts receivable? And the bank's going to say, hey, we'll go up to 80% on your domestic, but the export scares us, right? We're not going to do any, right? We're not going to go to Chile and try to collect on this debt if it goes
Yeah.
bad. And so surprise, surprise, most banks very conservative. They don't want to take anything that's not a guarantee. So
Mm-hmm.
with trade credit insurance, you get to leverage our AA rating by Standard and Poor, and we're guaranteeing everything up to 90%. There's a 10% co-insurance. So that gives the bank the confidence to say, well, I'll push it up to 85. I'll go to 90% on your domestic accounts receivable, and let's incorporate that foreign debt back into the borrowing base because there's a guarantee, right? Should something happen, it's not, you know, Matt's trucking company that we're going to go take to court or recover from. It's Allianz Trade, the largest insurance company in the world by holdings. So you go
Yeah.
from being able to get $2 million of advance rate to 275, which is, I don't know, it's almost like a 40% increase. So that's
Yeah.
how we really talk about expanding the borrowing base when we're discussing this. So this is the most complicated and probably the one we lean on the least, but this is a presentation
Yeah.
for a bank. So
Yeah, no, absolutely. And I think it, just depends on the goals of that business and what they're trying to accomplish. And if this is something that they want to do,
right.
if being able to have more credit with their bank, build a stronger relationship with their bank, they can essentially leverage Allianz.
Like once
Yeah.
your accounts receivable are insured by Allianz, you basically borrow our AA rating by Standard and Poor. You become AA. These assets become AA rated, and so the banks say, "Hey, look, right? Just as we just mentioned, banks hate uncertainty. They want guarantees. This is as close as they can get, right? They're
Yeah.
not having to go collect from Matt's trucking company in Chile. They're not going to do that. But what
Yeah.
they will say is, hey, look, Allianz put their stamp of approval on it. They're guaranteed to 90%. Why wouldn't I do that as well?"
Yeah.
Um, and so you can see how over time, when a company has that cash flow and what does a bank want you to do? They want you to borrow money, right? Within the restraints they put on it. So we talk to a lot of companies that say, hey, I'm not even, I have these an ABL loan from the bank. I don't draw down against it. I'm not using it. But there's times, especially like now, right? So say you have a
Mm-hmm.
steel company, all of a sudden there's tariffs on Chinese steel, people were buying it. There's market share available if you can move quickly, right? So a company might have, hey, I've got 10 new credit apps that just came in over the last 2 weeks, right? Now, Betsy, that's been in the credit desk for the last 30 years, is she going to be able to talk to 10 different, you're talking about 10 different applicants? That's 3 bank references each. That's 30. Is she going to be able to talk to them? And how long is that going to take? Weeks, right? Is that opportunity just going to sit there for weeks as opposed to working with us? You send over that. We even have a digital credit app. We can put it on our client's website, and those credit applications get routed to us directly. We say
Oh,
yes,
nice.
no, or partial. Um, and they're able to get an answer within 24 hours, as I mentioned, right? That last example, we took
Yeah.
companies, 20 clients that they've been working with the last 10 years. They're still guessing at it. And we said, hey, you can 3, 4, 5, 10x the amount of product you're selling to them overnight, and really help them boost their business.
Absolutely. And I'm really glad that you came onto this slide because I'm a total numbers girl. So can you break this down for us?
Yeah, so this is my favorite way to sell trade credit insurance, right? When you're selling extra revenue, you're selling extra profit margin. And so I like to refer this, my boss is not a fan of it, but I call it buried treasure, right? We're looking at your client list and seeing, is there buried treasure there that we can pull out without even it's always easiest to sell more to people that you're already selling to rather than go out and find
Mhm.
new customers. So we have a customer that comes to us, right? Operating facts, $40 million in revenue, average accounts receivable, 6 million, 10% gross margins, and they're turning that accounts receivable over 8 times a year, right? So they would come into a customer and say, hey, look, we're comfortable giving these guys $500,000 in credit. And then they come to us and say, hey, you can go up to 750,000 in credit and we'll insure that again up to 90%. So they get that crystal clear guidance. It's no longer educated guessing, right? And then, as I mentioned too, some of these businesses like logistics, they're getting RFQs, requests for quotations every day. They have, hours, maybe a day or two to make a decision, yes or no.
Mhm.
And so these companies can grow extremely quickly, but they're also susceptible to these hiccups, right? And so that creates an additional $250,000 in sale opportunity. But that's not just a one-off, right? Remember, they're turning that 8 times a year. So 8 times a year times 250, you're talking an additional 2 million in revenue and at 10% growth profit, that's a $200,000 increase in profit margin, right? So our the goal is to, as I was just mentioning, we want to turn those credit managers into project managers, where they're instead of them being the roadblock from sales to the CFO, they're more of an enabler, and they're saying, "Hey, give me more, go out and find more business." My best customers, they're talking to me 3, 4 times a week, saying, "Hey, I got this new opportunity. What do you guys think about these guys?" Right? You can throw
Yeah.
these opportunities over to us. We're going to come back and say, "Hey, we're ranking them at this because of XYZ. Here's the credit limit we set." So you might come to us and say, "Hey, we want to sell these guys 5 million in product," and we're going to say, "Hey, we'll approve it to 3.5." And they say, "Well, we really want to sell 5 million." We can go to these companies and request audited financials. These are typically private companies, but once we're saying, "Hey, look, we're trying to help you achieve your goals. You want to borrow
Mhm.
more from this company. Show us that you can take it, right? Show us that you
Yeah.
can that you're healthy enough to buy it." And if we get that additional financial information, we'll go back and we'll adjust our assessment.
Yeah.
So it's not something, again, that it should be a live project. And with our best customers, we become their outsourced. We're an outsourced sales desk with a guarantee, right? If Betsy in credit desk is wrong, she's not giving back her salary, and it's probably not going to cover the loss anyway.
And we love
Um,
Betsy.
and we
So
love
we're just
Betsy.
trying
She's
to
been here
empower her.
forever. Exactly. We want to supersize her abilities. Companies insure their land, their buildings, their machinery, their equipment, their inventory, their senior executives. They have insurance policies on them, cash.
Yes.
But accounts receivable can typically leave a huge amount of their value of their resources, and typically it is uninsured, right? And
Yeah.
and it's like the same thing too, right? People wait until they feel nervous about something to go ahead. But if you're in a building and there's a fire starting, that's not the time to revisit your insurance policy, right? Once you're feeling the crush on it, and who knows what's going to happen again with the U.S. economy. Once the dominoes start falling, at that point, it's kind of too late to, the building's already on fire. It's time to get out rather than revisit your
Right.
insurance policy. So this is kind of why we really implore people to at least have a conversation about this earlier, right? And maybe we don't work with everybody. It's not used car sales. It does have to be a partnership, and for us to
Right.
sell somebody on a 1 year policy, that's almost a loss leader for us. We want people to stick around for years. So we're trying to make sure that it's a good fit for both sides.
Yeah, of
And so
course.
never, once we have this initial conversation with companies, never have I heard, "Hey, this is a total waste of time." It's always, "Hey, I learned something. Maybe it's not a great
Yeah.
fit to move on." And we're typically trying to take those 4 pillars we mentioned and find a combination of all of those to make enough value for people to move forward. But when it works, it really works well for people. And, you know, nobody ever comes back and is like, "Hey, you know what? We've tried this for a couple of years. We really want to be making all of these credit decisions on our own again." That never happens. So.
Yeah. Yeah, no, that brings up a good point. No, I absolutely agree. And I appreciate all the information you shared. And you're right. It does have to be a good fit for everyone all across the board. And for me learning this, right now it's asking my clients, hey, how do you insure your receivables, right? Because that's not something that's part of the property and casualty
Right.
programs. And, not to the extent that you're providing all this data, you're providing this confidence to be able to boost their business, to grow, to scale, which is, one of my goals with my clients. I always want to see them succeed and be the best that they can be, and introduce them to new things. I really appreciate what you're sharing.
Yeah, well, thanks. Yeah, I mean, so we're typically going into these companies the same thing. So I work with a lot of ESOP companies, like employee stock-owned companies, and they're really good at making the products that they make, but rarely are they experts in credit analysis. Rarely do they have very strong developed relationships with lenders. That's typically the last thing that comes in. So being able to go to these companies and say, look, not only do you get to guarantee the sales that you've made, right? Should something happen, that you don't have to worry about it, but we're integral into working with your sales team to make sure you're maximizing all these opportunities, right? We're not leaving any money on the table. And I think that's really the important part, right? And, didn't really touch on bad debt, but companies do have what we call a bad debt reserve. They just have cash sitting there because they're expecting, just like a credit card company, they're expecting some of these payments to not go through. And, for some of them, they can be a little speed bump here and there, and that's understandable. But what we typically want to do with our clients is look at these top 10 buyers and say, hey, look, is there one or two of these? If something weird does happen this year, are these, company enders, right? Could one bad deal from a big buyer, could that crush this company or set it back 10 years or something? If you're taking, what we like to call, cracks in the windshield from a pebble, right? $2,000, $5,000, not going to knock you off base. But if you have clients where you've got $1 million in exposure 8 times a year, and that would be a significant enough roadblock to stop growth, is it worth taking a look at this? And as we mentioned, I think it is fairly affordable in terms of what it is. It is a percentage of revenue for the premium, but it's fairly affordable to have that, nightmare insurance and to have the growth side of the tool. So very, very rarely do we see people that if they are taking no bad debt, then they're probably leaving money on the table.
Yeah. Yeah. No,
by being
100%.
too restrictive with credit. Yeah.
Yeah. No, 100%. And I mean, it kind of comes down even to like not non-business things, right? Like, what's your risk tolerance? And if you were giving some certainty of something working out, would you actually take the leap and do it and go for it?
Right. Yeah. I wish we could do this in other things in life too. Like, dang, should I?
I know. Is there trade credit for life? For life decisions?
Yeah, it'd be great. They're like, don't worry, we'll guarantee it. You can go back and choose the other one if you're wrong.
Yeah, right. There we go. Oh my God, that'd be awesome.
Choose your own adventure. Yeah.
Well, thank you, Matt. I really appreciate you sharing this information. For business owners out there that are interested in learning more about trade credit, seeing maybe how this could apply to your business, see if it's a good fit, please reach out to Matt. I mean, he is a wealth of knowledge, has worked even internationally.
Yeah. I love running my mouth.
And,
happy to talk China and Hong Kong for a long time, Spain and Mexico.
So you're just very well versed in business. And I think anyone that speaks to you would gain just a lot of knowledge from that conversation. Yeah.
So feel free to reach out on LinkedIn. I'm very active there. It's probably the easiest way to get in touch with me. So Matt Kowalak, it's funny to spell, but just reach out.
Awesome. Thanks, guys. We'll just wave.
Perfect. I'm underwater, I think.